Okay, I think we are probably set to get started here. Hello, everyone, and welcome to another YCharts webinar. My name is Connor Kitko. I'm a product marketing manager here at YCharts, and I'm joined by my colleague and friend, Rushi Shah, Director of Product Management. How's your Thursday going, Rushi?
It's going great. Can't complain. Excited to have this call with you, Connor, and go over some cool data.
Absolutely. Yes, and as we do every quarter, today we are reviewing our latest economic update deck with visuals and data summarizing the third quarter of 2021. And our hope today is that this data, the visuals, and the commentary can inform your investment decisions going forward and into the new year. I think, as we all know, 2022 is growing closer very quickly. So time to get prepped for the new year. If you are a client, you can access the deck that we're going through today by logging into YCharts. And I'll show you really quickly how to do that. So in my dashboard, under support and support topics, I'll click on resources, the first option here. And then on this left panel, there's tons of great stuff in here, but I'm looking at presentation materials. And here is where you can go to download the deck that we'll be reviewing. Now, if you're a non-client, you're not a YCharts user, some exciting news is that for the first time ever, there is a downloadable Econ deck for you as well. It's slightly shortened compared to the version that YCharts clients get, but this free version is available for download on our website and on our blog. The fastest way to get that is if you went to get.ycharts.com/blog, and I think we'll be sharing a link in the Q&A. Again, for non-clients, you now have this free deck that you can use for your own analysis and for communicating with clients or colleagues. Two final reminders before I pass it off to Rushi to get into the good stuff. So number one, nearly all the data we're reviewing today was published by different government agencies in mid-October, and it's as of the end of Q3 or September 30th. And then the second reminder is that, as always, we will be emailing a recording of today's session to everyone that's on the call, and we'll also include the deck in that email as well. So keep an eye on your inbox tomorrow. Okay, we'll get back into the deck, and I'm going to pass it off to Rushi to get us started.
Yeah, thanks, Connor, and excited to go through this data with all of you today. So, like Connor mentioned, if you're not familiar with the Econ summary deck, it's a ton of great data, and we start off with just key market data and how the markets have done so far in Q3. So I'm just going to jump right into the first slide and talk through what was an interesting quarter. After Q2. You kind of saw positive returns overall across all indices, across all sectors. It was a it was a great Q2 overall for the markets. Q3 was a little different. We had more of a flat return if you're looking across all of these indices, except for MSCI emerging markets being the outlier there, being down nearly or close to 8%. But as you can see, we were trending higher until about September, and that's when the major market indices kind of fell off, and we ended the quarter with S&P 500 slightly being up and the NASDAQ and Dow being slightly down. And that kind of sets up the stock sector performance as well, which is the next slide in the presentation. And kind of the same story here. You have a mixed bag of results overall, but relatively flat for every sector. On the upside, you had the financial sector being up the most at about 2.74%, and the industrial sector being down the most at about minus 4.14%. So we saw some underlying themes within these sectors that have kind of switched gears compared to like Q2. And one of those themes are real estate, which we'll get into a little bit later on. Technology took a little bit of a breather as well and was relatively flat. So overall, pretty muted quarter across all the U.S. stock sectors.
Great. And moving beyond stocks and looking at different asset classes, this table shows us the performance of asset classes over increasingly longer look back periods. So starting in this first column on the left is a year to date total return, and then moving to the right, longer and longer look backs. So the clear trend here is that commodities are showing continued strength throughout 2021. And commodities are definitely considered good performers while inflation is rising. So far this year, they've been living up to that reputation. And also visible in this asset quilt, as we call it, is the recent swings for US growth stocks. So over longer look backs, definitely a strong outperformer. But then even in some of these periods where performance has been strong, relative to other asset classes, growth stocks are not necessarily topping the table. Now, this next asset quilt is the same data, same performance data, but we're slicing it a little bit differently. So we're breaking it out quarter by quarter. And again, we see, as we did on the last slide, commodities have been strong performers. We also see some of that volatility in US growth, these red squares here. But what we can also see is an interesting trend in international equities, shown here by World X USA, which is in this light orange, and then also emerging markets in green. So you kind of notice here that these two asset classes started to make significant progress and top the table in the midst of the COVID-19 pandemic, but now they are moving back to relative underperformers. Their day in the sun has kind of ended, and looking back at domestic equities and commodities as of late being the top performers. Now, I did want to jump into YCharts to show you all where to get these asset quilts, because we have this data built out as a template to make it super easy for any YCharts users to access it. So I'm back here in YCharts, and I'm going to click Tools and then Comp Tables. And this is where we're going to access that look back asset quilt, the first one we showed. So I'm going to click on New Comp Table to open up the menu. And the first option here is New from Template. Tons of great templates to start from within pretty much every tool on YCharts. And right here, we have Major Asset Class Index Performance. Just a couple clicks, and I have this awesome table built out for me here, all the same data we were just looking at. And then I can export this. I can create a PDF for sharing. I can export the data to Excel and start working with it there. Very, very similar process to access that quarter by quarter quilt that we looked at most recently. Now I'm in time series analysis, another data table based tool within YCharts. And the same process here, clicking on New Time Series Analysis to open up our menu, New from Template. And I know I'm looking for quarterly data. And our first option is that is what drives that visual that we just looked at in the presentation. So if you're not using the templates within YCharts, this is just one example of how they really are always there for you to reference and expedite your creation of communication materials. One more from me here. So talking about all these different asset classes lends itself nicely to a conversation around diversification. And this visual here shows how the broad stock market and 3 allocation portfolios have performed over the last year. So as you are considering allocations in 2022, are we de-risking? Are we adding risk? This visual here where we see the S&P 500 over the last year ending September 2021, a stellar 33.25% total return. And then as you start balancing out that portfolio, you're giving up some of that total return in exchange for some downside protection. Always a great conversation starter when it comes to asset allocation and portfolio management.
Yeah, that's great, Connor. And that kind of lends well into this next slide or leads into this next slide nicely. And just talking about that 33 percent increase in the S&P 500 and what that really means for valuations. And so this chart here talks about the Buffett indicator, which is essentially the ratio between the S&P 500 market cap and the US monthly GDP. And you can see just by looking at the top two lines in this chart that after that pandemic bottom in 2020, the S&P 500 market cap has really taken off from that low or that previous high right in March. And you compare that to the GDP, which is kind of just slightly back on track to where it was before the pandemic. So you're really seeing that outperformance in the S&P 500 market cap in general, and it's leading to this Buffett indicator to really take off, which you're seeing down in that bottom line, which compares a simple ratio of the S&P 500 market cap divided by the U.S. monthly GDP. And Connor, I did want to just kind of show how to create that ratio within YCharts. So if you could, go to the fundamental chart. And within here, we could just create the ratio portion of the chart that we were just looking at. And so Connor has his cursor over a section called ratios, spreads, and correlations. And what you could do within that section is actually create one of those lines. For this example, we want a ratio, so we'll stay on this page. And we'll start off with just searching for the S&P 500 market cap. And you can see the predictive search will help you find that right under the economic data section. And since economic data doesn't have a metric, it'll automatically populate the metric menu there. And then you can go ahead and search US monthly GDP here at the bottom. And that will give you that last economic data point and hit submit. And so now you have that ratio right on your chart, and Connor just changed the time frame on it. You could change the color of the chart if you want. You can add like a min, a max line. You can do all of that within these menus to basically create that fundamental chart.
Awesome. So much flexibility. Great stuff, Rishi.
Yeah, definitely. And then that's it for the market data. So the next part of it is bonds and interest rates. So Connor, you want to jump into some of the fixed income data that we have on YCharts and some of these visuals that we've created?
Yeah, absolutely. Interest rates definitely a top of mind topic with a lot of the Fed discussions that have been going on recently. So here we start with, on the left, a quick synopsis of some different rates and how they've trended over the past few quarters. And then on the right, we have our trusty yield curve, where in green, we're looking at the yield curve as of September 30th. In yellow is the yield curve 3 months before that, so the end of Q2. And then in blue is 1 year ago, what the yield curve looked like then. So looking at this yield curve, we see a healthy steepening compared to last year as the Fed continues to hold down short-term rates, and long-term treasuries have improved their yield by 62 basis points, which is the difference between the blue and the green out here for 30-year rates. And so that jumped to 2.08% compared to 1.46%. Maybe not significant compared to high interest periods of years past, but it is a jump relative to last year. And the Fed has already announced that they will begin tapering their purchases of assets as soon as the end of this month. And so the question for 2022 becomes, I think, once that tapering begins, how quickly will the Fed move to tightening, aka raising rates? So based on the recent comments, a lot of Fed fund followers, say that 5 times fast, are looking to July 2022 for that first rate hike. And the FOMC and the general market have become definitely more hawkish as of late. Plays into the conversation of valuation in the stock market as well, Rishi.
Yeah, definitely. And a lot of what you just kind of talked about is great, information. And this next slide really shows some of that data of what the Fed is doing. So you're hearing a lot more about what the Fed's thinking, when they're going to raise rates, when they're tapering, everything that you just mentioned, Connor. And these two visuals will kind of help you tell that story. So the one in the top left is the effective federal funds rate, and then it also has the target upper and lower limits. And you can see right now we're still really close to zero, and that will likely change at some point in 2022, or at least that's what people are expecting. And it kind of continues to tell the story about where we were in the pandemic and why the Fed is doing what they're doing, and that's what this chart at the bottom shows. And it has the high yield effective yield, as well as investment grade and the treasury rate on the same chart. You can really see how the high yield rate gets much more impacted in downturns in the market or downturns in the economy in general, versus the investment grade one didn't move as much, and the 10-year treasury just kind of lowered in 2020. So both of these charts will help you tell that story to your end clients of, hey, what's the Fed doing? Where are they looking, and what's coming up next?
Great stuff. And as these interest rates are held so low, a lot of people are hungry for yield, hungry for current income. And against this backdrop of rising inflation, you're looking for places to do that, maybe outside of your traditional fixed income holdings. So we've talked before about supplementing income using dividend ETFs. And here we are looking at REIT ETFs for the same purpose. So we all know that real estate has been extremely hot over the last year plus. And we're showing now the iShares Core REIT ETF compared to the US Aggregate Bond, or AGG. The REIT ETF is returning 34% over the last year versus a almost 3% drop by the AG. Similarly, both ETFs' dividend yields have been falling. However, you're definitely getting more from that REIT ETF. And then this whole storyline is reinforced by what we see in the AUM growth, where many investors have been putting their dollars into this REIT ETF, and hopefully enjoying those improved yields and returns as they do that. In 2022, it's going to be really interesting to see what happens with fixed income funds and ETFs. If yields do rise, then that's a net positive for those seeking income. But bond prices will definitely be negatively affected as those rates increase. And this is a great chart to compare two securities across different data points. So this is another one that I'm going to try to demo in YCharts for you quickly. To reset this here, and we're going to put in the AG, and we're going to put in that US REIT ETF. And we know we were looking at price, we were looking at dividend yields. Whoops, not dividend. And we were also looking at AUM. So just adding these all to one chart is not the prettiest, most explanatory visual you've ever seen, but what I want to call your attention to is this panel per financial metric, which is just a single button that's really going to make this so much more usable. Now we're telling a story, and wanted everyone to be aware of these panel and data format functionalities in YCharts as they're building out similar visuals to communicate with.
Yeah, Connor, before you jump back, I did just see a question come in about where the preset fundamental charts are. If you could just show where to find those templates within the fundamental charting tool.
Yeah, so up here in the top where it says new fundamental chart unsaved, it'll always say that when you're kind of working from scratch. If you're editing a save chart, it'll actually say that chart's name up here, but it's always that first option in this dropdown, new from template. And we've got tons of charts in here on economic data, equities, some charts from popular webinars that we've hosted in the past, coronavirus data. I think there's at least a couple dozen just within fundamental charts that you can jumpstart your analysis with.
Great, thanks.
Yeah, great question.
All right, and that brings us to the next section of the econ summary deck, which is macroeconomic data. So this isn't going to be about individual equities or bonds, but more about the macroeconomic landscape in general. And this first chart is great because it's basically a heat map of what's going on with some of those major leading indicators and what they're telling you. And there's some really interesting stuff that we're noticing in Q3. A few that I wanted to point out. One is just housing in general. So, um, a lot of people, because of the pandemic or because of the nature of their lives during work from home versus having to come into the office, changed. Housing really picked up last year, and we've continued to see some of those trends in those indicators. So a few on this visual: the U.S. housing starts and the the U.S. building permits have both stayed green in comparison to, of course, back in '08 and '09, during the Great Recession, when a lot of those indicators were red or not even close to where they are right now because of the strong housing market that we're seeing. Something else that's interesting is the U.S. index of consumer sentiment. You're seeing the lowest level at 72.8 from this last quarter, compared to, we haven't seen that type of level since back in 2012. So pretty interesting to see that value pretty low at the end of Q3. And moving on to another pretty hot topic as of late and it's been the U.S. trade balance. I mean, we've heard a lot about supply chain and a lot about just things moving along in the world and getting back to a new normal, and just a huge portion of that is the U.S. trade balance, and that's what this chart shows. So on the left, you have the U.S. total exports versus imports. And if you look at that line, I mean, it's amazing. We're at the lowest level ever since this has been tracked, which, if I'm looking at this correctly, it's going all the way back to the 1960s. So we're seeing the largest difference between exports and imports within the US. And it's shown a little more clearly on the right as well, where we have the green line, which is the US exports, versus the red line, which is the US imports. And you're really starting to see that divergence of those two lines, and the imports taking off a lot more in comparison to the exports. And then down at the bottom, we break out different countries or regions that you can view for overall net changes in exports and imports of goods and services. So the one that really sticks out here is Mexico, where you're seeing over 300% increase year over year in exports and over 430% in imports. So quite a change in comparison to a year ago when we were in the middle of the pandemic.
Yeah.
Connor, yeah, sorry, go ahead.
I was just going to add, sorry to cut you off. You mentioned with a previous chart about moving back beyond that pre-pandemic level, and here you see in the green our exports still not quite even where to the volume that we saw pre-COVID, whereas it's very easy to see in the imports that we have moved beyond that level. So again, that spread just widens, and it's not getting better post-COVID-19.
Yeah, definitely. And one thing I was just about to go into, which I'm glad you kind of mentioned, talking about the recession, is really shading that recessionary period. So it's clear to see what's going on here. So if you go back into the fundamental chart, and let's just create that US exports and imports line. There you go. And then what you can do, if you go on that longer time frame, you can actually shade the US recession. So you can see, if there's a huge fall off on these different indicators, you can see potentially why. So right there, Connor's hovering over chart options. Then you can go ahead and click Show US Recessions, and that'll plot those gray shaded areas to really help you tell that story of, hey, this is what happens during recessionary periods, and here's how we tend to return back after that.
Great. Okay. Moving on to our next slide here, turning to housing market data. So Rushi mentioned this a couple slides ago when talking about all of these leading indicators of the market. And there's definitely a lot going on with this slide. So let's break it down into parts and work through it that way. Starting with this chart in the upper left, we see the 30-year mortgage rate is rising away from that around 2.5% low level that it hit near the end of 2020. And the number of mortgage originations rose in response to this decline in mortgage rates. And the actually interesting component of those originations is the mix, or the percentage, which are refinances. So the percentage of originations which are refinances has been steadily declining and continues to climb even as mortgage rates are moving off of that low. So I think the takeaway here is that homeowners who didn't refinance at that absolute low point, there's still opportunities to lock in a more favorable rate, as mortgage rates are definitely lower than they were a few years ago. Now, this chart on the top right shows a few sentiment indicators from the National Association of Home Builders. And what's interesting here is that these sentiment indicators are once again moving higher from their pre-pandemic levels. So after taking a serious hit, these indicators did jump beyond what the previous highs were. And now, after cooling off a bit, they seem to be on the up and up once again. Finally, let's look at this data table at the bottom here. And I'll call your attention to the fact that the only indicator in this table which has consistently improved over each of these periods is this first line here, the Case-Shiller Home Price Index. So even with housing starts and housing permits taking a hit, and in the last few months, and then new single family houses sold and pending home sales being down year over year, home prices continue to rise consistently. And speaking personally, I guess, Rishi, this is definitely one of the things that makes me hesitant about, jumping into home ownership, is the fact that prices just keep climbing. And it's a little bit of a behavioral thing, hoping that it's going to come back down, but we'll see. Maybe real estate is just forever more expensive.
Yeah, we'll see as people, like we were talking about before, as work from home is more important. I think people are valuing their homes and more space more importantly. So, yeah.
And I'll jump into our next slide here, talking about U.S. dollar strength, which definitely has some tie-in to Rushi's conversation about imports and exports. Another busy slide, but starting at the top here, the U.S. dollar is shown in green, the ICE U.S. dollar index, tracking the USD against a basket of international currencies, currently strengthening, but pretty much flat over the last year. And meanwhile, inflation is driving this consumer price index, CPI, way higher. We got new inflation data just the other day, which was not the best news. Inflation 6.2%. And that is severely impacting the purchasing power of the consumer dollar, shown in blue on this chart. And now the bottom two charts just add more context to that ICE US dollar index, as we see the USD compared to the euro, the British pound sterling, the Chinese yuan, and the Japanese yen. And what I'll call out with these currency pairs is the US dollar against the euro and against the Japanese yen has shown some particularly strong recovery as of late. But against all of these securities, the US dollar has improved since about June of 2021. All right, Rishi, back to you.
Yeah, so I'll jump right into, this is one of my favorite sections of the Econ summary deck, because it's the charts of the moment. It's the charts that people are talking about, or what the data that people are talking about. So jumping right into the first slide, and this one is pretty insane at the supply chain woes that we're going through. And I don't know about you, Connor, but I need a new couch in my apartment, and the lead times are like 3 or 4 months. So I think I'm going to be sitting on the floor for a while. It's just crazy what's going on in terms of shipping costs, and you might want to start your holiday shopping early because of that. as you can see within this chart, on the left is the manufacturing vendor lead times and expectations. So you're seeing that overall, and this data comes from the Richmond Fed, the vendor lead times are at the highest levels since this has been tracked, which is before the year 2000. So we're seeing the highest lead times. We're also seeing the highest expected lead times overall that we've ever seen. So this is really causing, I don't know if we want to call it issues, but it's definitely causing supply chain woes overall throughout the world. On the right, you're seeing what the retail market thinks about this or is doing about this, right? So you're seeing overall US retail sales in blue, which continues to be pretty strong even after the pandemic. However, you're seeing that the ratio of retail trade inventory versus sales is, which is the purple line, is at pretty much an all-time low and pretty far away from where we were before. So you're definitely seeing this this difficulty of a really high demand for retail sales or retail goods in general, but the supply chain aspect of it not being able to meet that demand, which should be pretty interesting moving forward to the end of this year and also to next year.
Yeah. And one thing I think is really interesting, Rishi, about this chart on the left is that the averages for the expected and actual lead time are actually pretty much the same during this historical period, but you see how they're becoming more and more disjointed as of late, with usually expectations are kind of in line with reality. Here we're seeing reality is in terms of lead times are much further beyond the expected.
Yeah, definitely. And Connor, if we could, I'd love to show on the chart on the right, we have a few percentage changes. And we also have that purple line, which is just the overall value because it's a ratio. So if we could go back into YCharts and demonstrate how to do that, I think it's a pretty valuable tool if you're building charts within here. So if you want to go ahead and throw in the three indicators that we have on there. So I believe the first one was the US retail sales.
That's okay. We'll go out of order here. Sorry.
No, that's all right.
US retail sales. And then sales inventory. To jump over. US retail trade inventories.
There you go.
My apologies. Okay.
No worries. So here we're seeing that all three of these lines are just the overall values, and Connor can go ahead and change the data format to normalized, which essentially changes all of these to a percentage change. However, for the ratio, it's kind of odd to do a percentage change of a ratio. So we're going to want to change that back into just what the value is, which you could do by clicking on that annotate tab. And then that first line, the US retail trade inventory to sales ratio, you can annotate it and you can click on force original data format, which, like I just mentioned, will take that line and put it back into the original format of the indicator. So now we're looking at two percentage change lines and one line, which is just the ratio.
Awesome. Yeah, very helpful for economic data when a lot of it is expressed as, percent change, like a month over month or something like that.
Yeah, definitely.
Okay, back to me, Rishi.
Yeah, hit it.
Awesome. So this next slide, starting at the top, prime or not, shipping isn't free. Even though a lot of us have gotten accustomed to that free shipping, those costs are, showing up somewhere, right? So this slide looks at global shipping of capital and consumer goods, looking at the bottom two panels here. So capital goods, which represents like inputs for manufacturing, and then consumer goods, which are end products like clothing or shoes or what have you. Both rising exponentially, definitely over time. And what this top panel here shows is probably a bit of a lesser known indicator, but one that's really interesting. And a couple of us at YCharts have been following pretty closely. So the container shipping rate for 3,500 TEU vessels. And this represents the daily rate for a 6 to 12 month charter of a container ship that can carry 3,500 20-foot containers. So I know that a lot of numbers were just said, but basically, if you want one of these vessels to transport your goods and you need to charter that vessel as a manufacturer, it's going to cost you $83,000 per day to charter that container ship. Whereas middle of 2020, it was costing just $7,200 per day. So going from 7,200 to 83,000, a more than 10x increase in the daily cost for shipping goods around the world. And as I said kind of at the beginning, Prime on Amazon is free with your $100 membership, but this is obviously showing up in sticker prices for us, the consumer.
Yeah, that's amazing how much that line has gone up.
Yeah.
And yeah, kind of moving off the topic of supply chain and shipping, but more so the labor market. This is another huge talking point right now. I know everyone in the economy is dealing with this, and there's a lot of people talking about this term called the Great Resignation, and people either switching jobs or just fully leaving the labor markets. And you're seeing it in the data here. So the chart on the left has the job openings versus labor force participation. And you're seeing that based on the pre-pandemic level, and now we're not quite back to where we were in terms of the labor force participating and actually wanting to find a job. Whereas the overall US job openings has gone straight up after the pandemic because of the high demand of jobs needed to get us back to where we were before the pandemic. So you're seeing this disconnect of people wanting jobs versus the jobs out there. And so I don't know if the drive-through lines at your fast food restaurants or if the store lines just in grocery stores are going to get any shorter because of this discrepancy here. And a part of that and part of the story is just the overall unemployment insurance benefits payments, which is on the right. And you can see that pre-pandemic, this number was close to zero. And we've fallen off quite a bit since that pandemic top there, which was over $1.2 trillion. But we're not quite back at where we were before. So all three of these are just really interesting things to keep an eye on as we go into next year to see what's going to happen with the labor market in general.
Yeah, and this one's interesting too, Rushi, because talk about all those parts of the supply chain that are weakening or broken right now. Labor is needed at every link of that chain. So you hear about long haul drivers being in short supply. On the front line, people working in restaurants or retail. Every stage of the transaction, there's a labor shortage, which is definitely contributing to the issue.
Yeah, definitely. And Connor, I guess you can bring us home on the last slide. And a lot of this data and a lot of the changes in the data has happened because of the one big topic, right, which is the pandemic. So you want to talk us through what's going on with the coronavirus data?
Absolutely. Yeah, we're never going to get away. It seems like we're never going to get away from talking about this data. I hope that day comes very soon. But looking on the left here, we see US coronavirus cases per day and currently hospitalized in orange. And then on the right, US coronavirus deaths per day. So this is a quick visual synopsis of how the United States is faring against COVID-19 as we head into another winter season. Cases are down through October, as are hospitalizations, and we sincerely hope that these numbers continue to fall going forward. This visual, and especially what happened last winter, the winter of 2020 into 21, are hopefully strong reminders to be safe this holiday season with your family, your friends, and strangers that you come into contact with. So again, hoping to see these numbers coming down, but it's up to us, I guess. And that is our final chart of the day here.
Awesome. Well, thanks, Connor. And this was a lot of fun going through all the data. Hopefully, all of you on the call found it really helpful. Just to kind of reiterate a few things on where you can find this deck and where you can find other useful information. If you go back into YCharts and you hover over support, Connor, you'll see we have support topics there at the top. And we have a lot of useful information here, whether it's the resources. And if you click into the resources, we have all of our webinars pre-recorded, which you can go back into to find some great ideas and some great data. You can also go into the presentation materials section to find all of these econ summary decks, which Connor showed at the beginning. And there's a lot of other great stuff here in the support section. So as always, feel free to reach out to us with feedback, with thoughts. You can chat in on YCharts and let us know if you have any questions or need any help with the econ summary deck. But I think that's all.
All right. Yeah. Thank you, everyone.